All right, so we have our shopping for an auto loan presentation on the left and the note guide on the right. All right, so a car is usually going to be the second most expensive purchase for a consumer, and this is second to a home. A home or like some type of living situation is typically the first most expensive purchase, and then a car being the second. And there are two main ways that people purchase a car. So you can either pay cash if you have the full amount for the automobile, or you can get a loan. And the loan or a line of credit for a car is going to be probably the most common, typically because people don't usually have several $1,000s of cash laying around that they don't need for something else. So, getting a loan prevents them from having to take that much out of either a savings account or a checking account, something like that. All right, so let's go over some quick definitions. So an auto loan is going to be, very similar to any other type of loan like a student loan or a credit card. It's going to be borrowed money used to purchase an automobile. And so the differing contracts will change the terms depending on the lender that sends you the money. And so then the lender's definition is going to be the financial institution who offers the loan to consumers. So they have this could be a bank, or this could be a different type of financial institution, maybe a credit union, or specifically like a auto loan lender. And then, like we learned in the last couple weeks, what a credit rating is. So this is going to be the evaluation of a person's credit history. So this would be the number that their credit score is, and this is based on their repayment pattern. So have they ever missed a payment? How have I used credit in the past? And how long have I had my current job? Have I ever been unemployed for a certain amount of time? Those are all factors that go into your credit rating or your credit score. And then we also have a cosigner. So this is going to be a person who guarantees the loan for the original borrower. So for example, if you wanted to go and buy a car, your parents could co-sign for you, and that gives the lender a little bit more reassurance. This would mean that they can then go to your parents. So if you miss a payment, they then can go to your parents and try to collect that money from them because they are also liable for the payments. They co-sign with you, so they are taking some of the responsibility for paying for the vehicle. So far we are on number 5. What is a cosigner? And then what happens if a cosigner if the original borrower doesn't make the payment? So the cosigner is somebody who guarantees the loan for you. What happens to them? They can be charged that money because they are committing to paying that amount as well. I did notice number 3, I didn't cover this one yet from that first slide. So is it less expensive to purchase an automobile with cash or with a loan? So it is going to be less expensive if you pay cash, much like with any other type of loan, because then you're not paying interest. If you have an auto loan, you're going to be paying interest on that loan. So the longer it takes you to pay off, the more money you are paying total. All right, now that we have reached that, we can move on to number 6. So secured loan, it's going to be a loan that requires a cosigner or collateral. So there are loans that you don't have to have a cosigner, you don't have to put anything up. I'm just, saying maybe if I have good credit, then I don't have to have any of these. I can have a regular loan. If you have poor credit, sometimes you may have to have a secured loan. So they need to have a cosigner as backup to ensure that they are going to get their payment. Or you could put something up as collateral. And collateral means that the lender has kind of a sense of security because you are pledging that item. So if you get a loan and you could put your house up as collateral. So if I don't pay off my loan, that lender then has the right to come and take my items from me. So they could come and take my house from me if I made a loan with my house as collateral. And you can see that at this very last bullet point. If the borrower fails to repay the loan, the lender can then seize the collateral by repossessing or taking back the property. So they can come and they can take back whatever I set up as collateral as a way to get payment for the items that I had a loan for. All right, and so we know what the lender is. We learned what that definition is. And now we can talk about some examples. So you may be able to get a loan directly through the auto dealer. So you could go in and they could set up a loan for you. You could go to your bank, your personal bank. That is what a commercial bank would be a commercial bank and get an auto loan. You could get a savings and loans. They have specific places. They have specific banks, essentially, that are set up for savings and loans. And that's what I talked about a little bit ago. One of those financial institutions that's main focus is loans. Credit unions. There are online lenders. And then you could also pull from a life insurance policy or even go through your auto insurance. Some auto insurance companies can assist you with getting an auto loan. So those are going to be, several more than 4, but those are more than 4 examples that you could put under number 6. Some traits about them. So credit unions, those are typically going to offer lower interest rates by going through a credit union. Going through an auto dealer is usually the easiest option because they will do all of the work for you, but it's not always the best deal. So you may not always get the best interest rate. You may not always get the best financing, those kind of things when you go through an auto dealer because they're not necessarily looking for your best interest. They're thinking about themselves. They don't work for you as a banker at your personal bank or your commercial bank would. So you do have to do a lot of research before you go and look into buying a car because you want to have the best option for you. You want to get the loan that best fits your lifestyle and can give you the best option for the car that you're looking to buy. And there are things called consumer rights. So there are a couple pieces of legislation that protect the rights of consumers when they are going to buy a car. So, for example, this Truth in Lending Act that was put into place in the late 60s, it is going to be part of the Consumer Protection Act. So it's going to be like a subsection to this Consumer Protection Act, and it is going to apply to credit transactions. So this would be any type of loan, any mortgage or home loan, credit cards, anything where you have a line of credit with somebody else, and it requires that the lender disclose the key terms and all the costs in the lending agreement. So whenever they give you the contract, they have to include all of the details and list them. That way you have the opportunity to see them and you know what exactly you're getting yourself into when you are signing this contract for the loan. And there are 3 basic rules that the lenders follow when they're doing this. So, number 1, lenders cannot advertise a good deal that's not available to all customers. So they can't have a specific deal that you get that other customers don't know about and don't have the opportunity to access. Whenever they're running advertisements, they either have to include all of their terms and agreements, or they have to include none of them. So they can't just pick out the appealing terms to advertise. They have to give you all of the appealing and the unappealing, or they have to talk about none of them. And then lastly, if there are more than 4 installments that are required to pay for the good or the service, the loan, then they must say this last line that the cost of credit is included in the price quoted for goods and services. So they have to do all 3 of those things in order to follow this Truth in Lending Act. Some of the things that they must disclose in those contracts are going to be things like the interest rate, any finance charges, and they have to be able to allow consumers to easily compare other credit offers. So they can't make it difficult for you to see what other companies are offering, because then they're not really being even. They're not being fair to the consumer, who may not know better than to you know not compare, or just go with the easiest option. And we're going to stop there for this first part of the video, and we will pick up